Today, we're looking at an analysis report that, it's pretty much the textbook definition of a contrarian view.
It really is. The conviction is turned up to 11 on this one.
We're focusing on Applied Digital, that's ticker APLD, a really interesting player in the whole, AI infrastructure space.
Data center specifically, high-end ones.
Exactly. And the title of our source material says it all. It's called Applied Digital Crash, NO, the hashtag one AI setup before Jan 7 earnings.
So, no ambiguity there about how they feel.
None at all. So our mission here is to figure out why this report is arguing that a pretty big sudden price drop is actually a golden setup.
A gift, they call it.
Right, a gift. Just before this huge pre-scheduled catalyst, we need to unpack why they're so incredibly bullish and why they're just completely dismissing the sell-off.
And the timing is everything here. You have to understand the context. This analysis was put out on December 27, 2025.
Okay, so right at the very end of the year.
The very tail end. And the entire argument, everything we're about to talk about, it all hangs on one single date. January 7th.
The Q2 earnings release.
Confirmed for after the market closes. That date is the pivot point for their whole thesis.
Okay, let's unpack this. What exactly happened to APLD that, looked so scary on the surface?
Well, in one day, the stock closed at $24.05.
Okay.
Which was a drop of $1.67. So in percentage terms, that's a 6.49% decline. A big red candle on the chart.
And for most people, you see that kind of drop, especially without any obvious bad news attached, and your first instinct is to panic.
It's pure fear. You think, what do they know that I don't? You hit the sell button, it looks like the start of something really bad.
A classic red flag. But the report, it just immediately slaps this really aggressive label on it. They call it a bear trap.
They do. And they challenge that drop head on. They basically refuse to connect it to any, real problem with the business itself.
How do they frame that?
They ask this rhetorical question. It's great. They say, we dropped 6.5%. Why did the AI revolution get canceled? Did NVIDIA suddenly stop selling chips? No.
I like that. It forces you to think beyond the price chart.
It really does. So if it wasn't a fundamental problem, what was it?
That's the million-dollar question. What mechanism does the report blame for a sell-off that sharp?
They say it's classic holiday low-volume manipulation.
Okay, break that down. Low volume because it's the last week of the year.
Exactly. A lot of the big institutional traders are on vacation. The markets are thin, which means it's just easier for the funds that are still trading to push the price around.
And the report suggests that they're doing that for two specific reasons.
Two main reasons. First, tax loss harvesting.
Right, the year-end accounting games.
It's purely an accounting move. Institutions sell their losing positions to book a loss, which then offsets the capital gains they've made on their winners. It reduces their tax bill.
So it has absolutely nothing to do with their belief in APLD's future. It's just a tool.
A tool for their accountants. That selling pressure hits the stock on low volume, and it drives the price down artificially.
And what's the second reason?
The second part is a bit more predatory. They call it shaking out the weak hands.
Scaring the retail investors.
Precisely. They amplify the selling to trigger stop losses and panic people with smaller positions into selling their shares cheap.
So by the time January rolls around, the institutions have their tax write-offs, they've bought back the shares from the panic sellers at a discount, and the stock is ready to rebound.
That's the narrative. It's a classic institutional playbook, according to this analysis.
It takes a lot of guts to see a 6.5% drop and just call it a maneuver. So for you, the listener, the key takeaway here is that the report argues the only thing that really changed is the price.
The stock is just on sale.
Exactly. It turns what looks like an ugly day into what they call, very confidently, a golden opportunity.
So let's do that. Let's ignore the noise. What is the core business case here? Why is the report so confident in the fundamentals?
This is where we get to the really good stuff. We have to shift from the trading games to the actual business model.
And the strength of that model comes from a really powerful analogy they use. The report calls APLD the landlord for the AI supercycle.
The landlord. I love that framing. It simplifies everything.
It really does. Because APLD isn't trying to build the next great AI. They're not making the chips. They are providing the one thing that is absolutely 100% indispensable.
The physical infrastructure.
The physical home. Think about it. NVIDIA, they make these incredibly powerful engines, these GPUs. But you can't just plug them into the wall in your garage.
No, they need massive, purpose-built buildings with specialized power, insane cooling, top-tier security.
Exactly. They need to run 2047 at peak performance. And that's what Applied Digital's AI factory clusters are. They're just building and operating these highly specialized data centers.
Which makes their revenue stream much more stable, right? It's not based on, say, crypto prices or short-term chip demand. It's based on long-term contracts.
Yes, exactly. They're a utility for compute power. And the global demand for that compute, the supercycle, that didn't change one bit on December 27th.
So that core thesis makes the 6.5% dip seem, well, kind of irrelevant in the grand scheme of things.
Entirely irrelevant.
Okay, but here's where it gets really interesting. We have to connect this landlord idea to the catalyst date, to January 7th. What is Wall Street actually expecting to hear?
The big thing is revenue. The market expects to see a major ramp up in revenue from these new AI factory clusters finally coming online.
So these huge projects they've been building are finally starting to, generate cash.
Right. It's the transition from spending money, capital expenditure, to making money. And the Q2 report is supposed to be the first big proof point of that transition.
And the analysis highlights one absolutely critical number that they believe makes the current stock price just, well, illogical.
The $5 billion backlog.
$5 billion, with a B.
Yes. And that is the single most important figure in the entire report. They're very clear. This isn't some potential sales pipeline. This is signed multi-year contracts for data center capacity.
So it's future revenue that is already locked in.
It's secured.
Yeah.
And if you put that in context, the company's entire market cap is, it's just a fraction of that backlog number.
That's a huge mismatch. The company is valued at less than the revenue they've already contracted to bring in over the next few years.
It is. And the report's argument is very firm on this. If the company gives any positive guidance on converting that backlog into actual revenue on the earnings call,
then the stock simply can't stay at $24.
It cannot. The market will be forced to re-rate the stock higher to reflect that proven, secure income stream.
So let's talk about that re-rating. What kind of upside are we looking at if this thesis plays out? The report gets into analyst consensus, right?
It does. And this is important. It's not just the report's author who's bullish. They point to institutional analyst targets.
From who?
They cite respected firms, Needham and Craig-Hallum, and their consensus price targets are in a range from $45 all the way up to $58 a share.
Wow. Okay, so for you, the listener, let's put that into perspective. The stock price when this was written was $24.05.
Right.
So a move to even the low end of that range, to $45, is almost a 100% upside.
It's a staggering potential return. It creates a massive risk-reward imbalance in favor of the bulls, assuming the earnings are good.
But that's always the risk, isn't it? Earnings can go either way. How does the report handle the immediate risk of the event itself?
That's a great question. And they look at the options market to answer it. The implied move on earnings.
Which is what the options traders are betting the stock will move up or down.
Exactly. And it's pricing in a move of roughly plus or minus 15%. So the market expects a big swing.
The question then becomes, how confident is the analysis that the swing will be up and that it will be more than 15%?
And their answer is, well, maximum bullish.
Of course it is.
They really frame the current price as this last chance opportunity. They basically challenge anyone thinking of selling. They ask, do you really want to sell your shares for $24 right before they announce record infrastructure growth?
And talk about that $5 billion backlog.
Right. It's a psychological argument. They're saying that selling right now with this massive catalyst just days away is just fundamentally irrational. It's a trade based on the business, not the squiggly lines on the chart.
Okay, let's shift gears and actually look at those squiggly lines. Let's talk about the technical setup, because even if it was a bear trap, you still need the chart to confirm a good entry point.
For sure. And the technicals, according to the report, they lined up perfectly with the bullish story. Even after that big drop, the stock was bouncing right off the $24 level.
A big psychological support member.
A huge one. Round numbers always act as magnets for support and resistance.
And the report gave a very specific level, a line in the sand, they called it.
They did. That level was $23.80.
So as long as it stays above $23.80.
So as long as it stays above $23.80, the uptrend is totally intact. Holding that line proves that the drop was just a shakeout, not a real trend reversal. It shows the sellers are exhausted.
So what's the path forward then? What are the upside targets the analysis laid out for a rally into January 7th?
The first, most immediate target is a technical one. Filling the price gap at $25.75.
A gap fill. Always a powerful magnet.
A very common target. Once that's filled, they were looking for a pre-earnings run up toward $30.
And the big prize. If earnings on January 7th are as strong as they hope.
Then the next major goal is to go and challenge the 52-week highs.
Which are up around $40.
Around 40, yes. And breaking through 40 is what would open the door to those bigger analyst targets we talked about, the $45 to $58 range.
The report also mentioned a technical indicator, the RSI, the Relative Strength Index. What did that show?
For anyone who doesn't stare at charts all day, the RSI just tells you if a stock is overbought or oversold.
And in this case?
The report noted that the RSI was cooling off. It was not overbought anymore. And it's actually a really good thing for a potential rally.
Because it means there's fuel left in the tank.
Exactly. It has room to run upwards before it gets overextended. The summary was that the stock was technically primed for a bounce.
So, to recap this whole thing, the analysis report's core message is, what? Don't panic.
Basically, yeah. Don't be scared by the short-term 6% drop. The fundamentals are strong, the catalyst is days away, and the upside is huge.
That role as the AI infrastructure landlord, plus that $5 billion backlog, is the real story.
What I find so fascinating here is how they weave it all together. They take this really emotional event, the price crash, and they combine it with these long-term fundamental drivers to create this really clear, actionable thesis.
They use the selling as confirmation, not as a warning sign.
Exactly. They say, look, the institutions are just playing their year-end games. This isn't risk, it's opportunity. They're basically handing you a better entry point.
So, what does this all mean? The analysis is fundamentally arguing that you, the investor, should completely ignore the short-term noise. Ignore the games.
Focus only on the real, material corporate event that's happening on January 7th. It's a call to look past the chart and look at the contracts.
It is. Which leaves us with a really provocative final thought for you to think about.
And it's this. If an asset's price drops for reasons that have nothing to do with the business itself, things like tax loss harvesting, does that selling pressure actually reflect real risk?
Or does it just create a predictable, temporary buying window for investors who have a slightly longer time horizon?
It really forces you to ask yourself where the true value comes from. The daily flicker of the price on a screen or the $5 billion in signed contracts.